foggy, Portland rainy Monday morning. I hope you're all doing well. I want to kick off this weekly video here real fast by just saying we're going to make some changes on this thing. I've been hitting pretty solidly 20 minutes at a pop, and even I barely have the attention span to hang on for that. So going forward, I'm going to try to make a couple shifts. I'm going to try and just focus on two things at most each one of these videos, except for perhaps when we get into like when the monthly action results come out and we can see what the market activity for the prior month did. Those may go longer. Sorry, there's always a lot to unpack on those. Otherwise, we're going to focus on basically two things. At least today, we're going to focus on two. Mainly just because get a lot of feedback coming back on the videos, and take all the videos commentary we can get, I guess, anyway. But just want to kind of just try to shorten these things up here a little bit, make them a little bit more succinct. So if you have any questions while I'm going through these couple of things, put them in the comments. I'll see it here live, real time. I'll see if I can address them. If you want to heckle me, go for it. I'm in a good mood today. Otherwise, we're going to jump right in real quick, kind of the high level, and then cover our two topics. So, Jeff, how's the market? All right, Century Lockbox activity. This is every time Gene and I go show a house, we open the door, registers activity. So Portland's up slightly from last week, pretty much on pace from this time last year. So no real big surprise other than the market feels like it's a lot feverish than that would indicate right now. But there's also a lot less homes to show, so your concentration of activity is pretty dense. Washington, the Vancouver side tailed off a little bit, but it is up prior to last year. I can tell you this, I am licensed on the Washington side. I've got clients who are working up there in Vancouver, Camas, Washougal areas. It's a frenzy. It's absolutely crazy up there. There's less inventory in the Vancouver metro areas than the Portland metro, so it's a little bit tough sledding to lock in a good home up there. So, all right, there you go. That's your quick overview of what's happening. Things are cruising along just great. Two topics I want to talk about this week. Interest rates for one, right? We talk about inventory all the time. I'm not going to hit on that this week. So interest rates, what's happening, and sort of what's possibly to come. And then secondly, we're going to talk about kind of the true cost of Portland housing. So that said, let's just jump right in on the interest rate stuff. And I am going to give a full shout out here. Riley Hayes at Root Mortgage is one of our lending partners we work with quite a bit. Riley puts out a great weekly newsletter every Friday afternoon, and I like him because he's kind of like me. He gets nerdy in the details, nerdy in the math, and kind of the economic trends of what's happening. So it's a pretty good read. And this past Friday, I thought was a spectacular one. So we kind of want to talk about it, especially because he's talking about the interest rate risks are returning. I'm going to hit on just a few key points that he talked about in his newsletter. But if you look at some of that last sentence of that blurb there, it's beginning to flash a warning about the volatility that's coming. So we're going to talk about that here in a second. So Riley, keep those newsletters coming up. All right, a couple points that Riley was making in his video, or in his newsletter rather, is throughout history, if you look at kind of the relationship between the treasury yields and mortgage rates, they typically follow a pretty symbiotic relationship. As treasuries tick up, so do mortgage rates. As treasuries tick down, so do your mortgage rates. They just follow part and parcel until COVID hit. So in 2020, we had such a divergence of everything. All the fundamentals of our market stopped because we haven't done this in 100 years. So everything kind of broke, everything kind of split apart. So you see that you had a divergence between treasury yields and the mortgage rates. So whereas we used to be able to say, if the yields are ticking up, your mortgage rates are going to go up. In this case, they went down and down and down and down. And so there was, for folks like Riley, when you would ask them like, hey, what do you think it's going to happen with mortgage rates? Well, long term, thought would say this, but right now, all bets are off, right? Because you saw this big divergence. So the point number one he made is we had that throughout most of the year, but rates have been ticking back up or have been trending down as yields are starting to tick back up. And for the first time in pretty much a year, we've come back in line with each other. So the treasuries and the mortgage rates have reunited. So what we're going to have to wait to see is, do they stay reunited or do they split back apart again? But if you look back over, in this case, past few years, that's all it shows up on this chart, but it's going to go back for decades. It is a symbiotic relationship. So the point he's making is we're back in line, expect that to stay back in line, and we're going to kind of see what happens. He also kind of highlights it here, in a secondary graph he showed, was kind of the difference between the mortgage rates and the treasury yield. It sort of showed sort of as things kind of bounced around. There's a normal range you would expect to see of disparity between the two, and they stayed pretty close in par with each other. And throughout 2020, there was a big spike. Things kind of came apart, and now we've drifted back into that quote unquote normal range. So I think going forward, all things basically are going to come back to kind of that key science of, mortgage rates are going to follow your treasuries. Treasuries are going to follow the economy. So he basically he ends his weekly newsletter with, in this case, the bottom line: it's harder for these to take part of the volatility. We should be more concerned about rates following suit than we were conditioned to see in all of last year. The economy is picking up. The vaccines are rolling out. So as treasuries are going to start picking up, expect to see mortgage rates following as well. Basically, here's your Cliff Note version. Your interest rates are at risk going forward. Expect to see the slow, arguably slow for a while, creep up on rates. So we have probably bottomed out. So keep that with risk. So that's topic number one. We're already halfway done here, and I'm 6 minutes in. Perfect. We're going to shoot for 10 minutes or less on these. Again, if you're watching live, if you got questions, comments, heckling, throw it on the comments. I'll see it here live. Second point I want to make: Jeannie and I hear quite a bit from people. People talk about, I can't afford to buy a Portland, house in the Portland area. It's too expensive. I'm just gonna rent because renting is cheaper than owning a house. Can't afford to buy. So I want to submit the thought that you can't afford to not buy a house in the Portland metro area. And certainly if you're thinking about renting a home instead, it's absolutely significantly more expensive to rent. So that's my submission. Let's pick that apart. Before we do that, let's jump into a couple things. Here's a couple of facts. We ended the year last year at $494,000 of your average, I can't spell this morning, average home price in the Portland metro area. It was up 7.6%. So roughly $459,000 is where we started the year on an average price, right? So we started at $459,000. The average home price by the end of last year was $494,000. Let's just kind of keep that part in mind. Now let's make some assumptions. Let's assume throughout the year, whether you're at right now or whatever the case may be, average mortgage rate during that period, 3%. We know it's lower, but let's just go with 3%. Property taxes. Let's just say the average home is going to have $6,000 of property taxes. That's going to be high, but let's just go with that. Insurance, homeowners insurance. You got to pay that if you're owning a house, $100 a month, probably close in the ballpark. And if you're not putting down, in this case, the scenario I'm going to throw out, you're putting down 5%. So you're going to pay PMI, private mortgage insurance, on your mortgage, a couple $100. That's going to be the ballpark of what that real cost would be. Keep all that in mind. Don't worry, we're going to break all that out. So now, given those assumptions and given the kind of those key facts of price points, and again, we're going to talk about a 5% down mortgage. So $20,000, round numbers, is your starting point for jumping in. Top box, here's your net cost of home ownership, right? So your mortgage P&I, principal and interest, $1,979 a month. There's your taxes, insurance, PMI. You're gonna pay $100 a month on average to fix the house, right? Toilet's gonna break or something's gonna go wrong, you gotta fix it up. Those are all your costs. Now the benefit is your monthly appreciation rate, $2,900. We're getting that from looking at the $490 some odd $1,000 average price at the end of the year versus the beginning of the year. Right, that $38,000, whatever it is, works out to roughly $2,900 a month of property appreciation. That is real value for you as you own your home. Now, granted, it's not liquid cash being deposited in your bank every day, but it is being put into your long-term piggy bank. Okay, so if you factor all those out, let's just net out. What does it cost you? First, $2,879 a month to own your house in Portland. What are you getting for it on average monthly? $2,900 a month. So not only is the benefit of owning that home covering your mortgage payment, you're technically kind of forward banking. You're making $21 a month by owning a house. It's a free house. You had to put your 5% down. But monthly, on a net basis, it really doesn't cost you anything. Now, you've got to be able to cover cutting that check every month now. But here's your argument. If you're getting into that first-time home ownership position, things are tough, get a roommate, do whatever you need to do because it's going to pay for itself, right? The house is free. Let's go down below. The net cost of renting, The average rent in the Portland metro area is $1,484 a month according to rentcafe.com. Had to find that one, but that's your total cost of renting. Repairs, you don't have any, right? Perfect. What's your benefit? Oh, there's none. There's no appreciation. You're paying the landlord. The landlord's going to get that benefit above. So your net cost now, it's $1,484 a month. That's your cost disparity between owning versus renting in Portland. It's about $1,500 a month difference. Positive swing for you. So owning a house in Portland, I'd make the argument it's free. If you can cover the short-term monthly, because of the equity value that you'll gain. Now, we're running 7.6% was the average during last year. The market certainly heated up last year, but I can also tell you this, your long-term annualized growth rate for the Portland metro area is 4.7%. That's if I math that out starting back in 1999 through a couple of months ago, 4.7%. That factors in the Great Recession. It follows in the run-up leading up to it, rather. It factors in the tank that happened after it. Factors in the recovery, 4.7%. It'd probably be more interesting if I looked at that number, say, for the last 10 years. It's going to be higher than that. So 7.6 probably won't always be your monthly or your annual effect going forward, but you're probably not going to be all that far off. This math will still hold month in, month out, year in, year out, even if you have a 4% growth rate in home values. You may not be making $21. It's going to cost you maybe a few $100 versus $1,500. Bottom line is this. Portland real estate values are going to continue to grow. We don't have the supply. We've got the urban growth boundary. Building new supply is going to be painful. It's going to be hard. It's going to be slow. We've seen lumber prices double. This is your solid investment. If you can at all figure out how to jump in and buy instead of rent, do that. If you need help, want some advice, or want to talk about a strategy of how to get from renting to owning, or you're trying to figure out how do I do that step up, because now's that right time. And you're just you want to bounce some ideas off a wall, give us a call. Gene and I have these conversations all the time, and we're happy to have that conversation with you. There you go. That's your weekly update. I'm 12 and a half minutes. We're getting better. I'll go faster next time too. So if you have any questions after you watch this, again, put them on the comments. We'll see them after the fact. We'll do our best to follow up with you. Otherwise, if you have questions, give us a call, text, email. Have a great week. Talk to you next time.